The yield curve has inverted, and in certain pockets of the market, people are panicking about this inverted yield curve. And we take a look at this article by Bloomberg. It mentions that we should be prepared for a recession by the end of 2023 with this yield curve inversion. So what is the yield curve and why is it important? Before we begin, if you are new to this channel, my name is Linus, and in this channel I share all things related to the stock market, so both investing and trading. If you want more videos such as this, make sure to subscribe to my channel because each week I release new videos about investing, trading and the stock market. Alright, so let's first take a look at what is the yield curve. Simply put, a yield curve is a line that plots the interest rates or yields of bonds with the same credit quality but differing maturity dates. So there's something that you need to know about bonds over here. So for bonds, there are different kind of qualities of bonds. So we have the higher quality bonds and lower quality bonds. So in the case for the yield curve, when we are comparing bonds with different maturity dates, we want to compare bonds with the same credit quality. And the yield curve that is most paid attention to is the 2-year and 10-year US Treasury bonds. So for US Treasury bonds, we have the 3 months, 2-year, 5-year, 10-year and 30-year. But the most paid attention to in the financial markets is the 2-year and 10-year Treasury bonds. So how do we plot the yield curve? So like any graph, we have the y-axis and the x-axis. So the y-axis is the vertical line and then the x-axis is the horizontal line on the graph. And for the yield curve, the y-axis indicates the yields of the bond or the interest rates on the bond. And for the x-axis is the maturity of the bond or when the bond expires. So for the graph of the yield curve, we say that the yields are plotted against the maturity dates. And this is an example of how the yield curve look like. So on the y-axis, you can see the yields, and on the x-axis, the horizontal line, you can see the maturity dates. And based on the different maturity dates and the yields, you can plot your yield curve. And when it comes to the yield curve, there are 3 main yield curve shapes. For the first one, we have the upward sloping shape. The second, we have flat. The third, we have downward sloping or inverted. So let's first take a look at upward sloping. So for upward sloping, this is the normal shape of the yield curve. And when the yield curve has this shape, it means that the longer maturity bonds have higher yields compared to shorter term bonds. The next shape we have is flat. So for the flat shape, it means that the shorter and longer term yields are close to one another. And for the third shape, we have the downward sloping curve or the inverted yield curve. So this indicates to us that the shorter term yields are higher than the longer term yields. Now let's take a look at the graphical illustrations of the 3 different shapes. So over here, as mentioned earlier, the y-axis is the interest rates or the yields, and the x-axis is the maturity date. So the green curve that you're seeing on the screen is the normal yield curve or the upward sloping shape. Then the yellow or golden curve is the inverted yield curve or the downward sloping shape. The third shape over here, which is the flat shape. So basically a flat shape is just a horizontal line across. So we have went through what the yield curve is, how the yield curve is plotted, and the 3 main different yield curve shapes. So the question now is, why is the yield curve important? One of the reasons why the yield curve is so popular is because many people in the financial industry look at the yield curve as a leading indicator of a possible recession. So to them, the yield curve is a recession indicator. So why is the yield curve used as a possible recession indicator? Let me explain. So typically, the longer the maturity of the bonds, the higher the yields. So just think of this example. Let's say you have some cash lying around and you want to put it with the banks. And the bank offer you 2 options. So you can put your money into a longer term account or a shorter term account. So which account would you put your money in? It depends, right? Because if you're going to put your money into a longer term account, you will definitely demand a higher interest rate on that account compared to a shorter term account. And why is this so? This is because you're locking your money away for a longer period of time compared to a shorter period of time. So if you're locking your money for a longer period of time, you definitely expect to be paid out a higher interest rate. And this is the same for bonds. And that is why typically, the longer the maturity of the bond, the higher the yields. This is true for most of the time. However, there are certain times where this is no longer true. And this exception usually happens when investors are uncertain about the near future, so they will sell their shorter term bonds and buy longer term bonds. Okay, so stay with me. So what happens when investors are unsure about the near future? They are going to sell their shorter term bonds and buy longer term bonds because they are not so optimistic about the near term future. And because investors want certainty, they will move from shorter term bonds to longer term bonds. So they will sell their shorter term bonds, and by selling their shorter term bonds, this would cause the price of the shorter term bonds to fall, and thus the yields on the shorter term bonds will rise. And as these investors sell their shorter term bonds, they will look to buy their longer term bonds, because in this scenario, the longer term bonds are relatively safer compared to the shorter term bonds. So investors will look to buy the longer term bonds, and this would cause the price of longer term bonds to rise, and thus the yields on the longer term bonds will fall. And when the yields on the shorter term bonds are higher than the yields on the longer term bonds, this will cause the yield curve to invert. And that is why many people consider the yield curve to be a leading indicator of a recession. And to recap, why is this so? So because typically, the longer the maturity of the bonds, the yields on the longer term bonds tend to be higher than yields on shorter term bonds. Because investors will be expecting to be paid a premium for locking their cash away for a longer period of time. But this all changes when investors are uncertain about the near future. When they are uncertain about the near future, they will sell their shorter term bonds for longer term bonds. And when many investors sell their shorter term bonds, this would cause the price of shorter term bonds to fall and thus cause the yields on these shorter term bonds to rise. And because of the increase in demand for longer term bonds, this would increase the price of the longer term bonds. And when the price of longer term bonds rise, this would cause their yields to fall. So over time, as the yields on the shorter term bond rise and the yields on the longer term bonds fall, this would create an inversion of the yield curve. And this is what it looks like. So for the bolded blue line, that is how the normal yield curve looks like. So as you can see in the normal yield curve, the longer the maturity of the bond, the higher the yields. But when investors are unsure about the near future, they will sell their short-term bonds to buy long-term bonds. And this will cause the yields on short-term bonds to rise and the yields on long-term bonds to fall, thus creating an inverted yield curve. So exactly how accurate is the yield curve in predicting past recessions? Let's take a look. So over here we have data from 1979 all the way to 2017. So the grey columns are periods of recession and the blue line is the difference between the 10-year and 2-year treasury yields. So basically what the blue line is that you take the yields on the 10-year treasury minus the 2-year treasury. So a positive number will indicate that the yield on a 10-year treasury is greater than the 2-year treasury. And a negative number will indicate that the shorter term yield, which is the 2-year treasury, is greater than the longer term yield or the 10-year treasury. So over here you can see that throughout the years from 1979 to 2017, every time the blue line goes below zero and into negative territory, a recession happens soon after. So the first example will be during 1980 to 1981. So you see that the blue line goes below zero and then a recession took place in 1981. The next one is during 1989. So during 1989 the blue line goes below zero and then the recession happened in 1990 to 1991. The next time that the blue line goes into negative territory is during the year 2000, and you can see that the recession happened in 2001. And similarly, during 2006 and 2007, we see the blue line going into negative territory again, and then we had a recession in 2007 and 2008. So based on recent historical data, yes, the yield curve is a good leading indicator of a recession. Now let's take a look at the current data. So over here you can see that this data is the 10-year treasury minus the 2-year treasury. So right now we are currently at this point over here. So if we zoom in over here, let's put it over here, you can see that we briefly reached negative territory over at this point over here. At this point, the spread between the 10-year treasury and the 2-year treasury was negative 0.05. So we did indeed get an inverted yield curve for a brief period of time recently. And that is why many investors were freaking out and panicking just recently. So is this an indication that a recession is on the horizon? Only time will tell, but based on recent historical data, a recession might be likely. How soon? We do not know. It could be in the next year, the next 2 years, the next 3 years. In my opinion, all these indicators can be used to help you make a more informed decision. But at the end of the day, what I believe is the most important is the price chart. And let the price chart determine your next step of action in the stock market. So hopefully you have enjoyed and learned something from this video. If you did, smash that like button because it really helps the channel grow and allow me to produce more content such as this. If you want more weekly stock ideas and tips, make sure you join my Facebook and Telegram groups, because in those groups I share with you weekly stock ideas, tips and market updates. You can join those groups by clicking on the link down in the description below. I'll see you in the other videos to your financial success.